So as university students, I bet this one will be interesting to you. We're going to talk about colleges and university accounting. All right, so, we're going to learn how to apply the accrual basis of accounting, which you already probably know how to do that pretty well. Just with those distinctions between private colleges and public universities. Public university like Kingsville. Financial statements that go with those, and identify split interest agreements, and how do you account for that. So first of all, we're talking about two different kinds of universities. So they have slightly different accounting rules. So there's what we call a public university. So unlike a public company, which is owned by stockholders, a public university is literally run by the public, right? It belongs to the state. Like Texas A&M Kingsville belongs to the state of Texas. It's a state university, along with A&M Corpus, along with the University of Texas, along with Stephen F. Austin, along with Lamar, along with UT Dallas, right? So all those state universities, that's what we call a public university. University of Michigan, University of Alabama, University of Arkansas. All right, so public universities. There are, of course, community colleges and things like that, so those are public schools too. There's what's called a private university. So think about Rice University, which is what we're going to use for our example when we do the homework, but Harvard, Vanderbilt, Trinity, all these private schools that are paid, basically they support themselves. Students pay tuitions, high tuitions, because, well, they have to support a whole university. And people donate big amounts of money, right? Like Harvard and Yale, those things, their graduates donate millions of dollars. They have these huge endowments. So private is just totally private. No state support goes to it. Whereas Texas A&M Kingsville, yes, we charge tuition, but the state's also kicking in quite a bit of money to help support the place. So private don't get the subsidies. Or appropriations would probably be a better word. So there are also something called investor-owned universities. So think University of Phoenix. They're actually for-profit universities. There's several out there. ITT, DeVry, Canyon, Western Governors. So there's these investor-owned, and people buy stock in them. You could go buy stock in them, and they earn a profit and they pay money out to the owners. So that's an investor-owned, and we're not going to talk about those. Why? Because that's just a business. So you would learn how to do that stuff in Intermediate 1 and 2. And Advanced. It's just a business, right? So, but we are going to talk about private, not-for-profit, so like Liberty University, or public university like Clemson, right? It's state university. All right. So, FASB sets the standards for privates, just like we talked about not-for-profits in Chapter 10, FASB. GASB, we've already learned. In fact, we already kind of looked at the state of Texas maybe a little bit and talked about the state of Texas, and we know that Texas A&M Kingsville is part of the A&M system, which is a university belonging to Texas. And if you were to go out in our Blackboard and look in that folder with the example financial statements, you would see under the state of Texas a column for universities. So they report all the universities discretely, but not each one. Just they lump all the universities together. So GASB applies, but basically Texas A&M Kingsville is run by the state. They have the final say in what goes on here. And of course, investor-owned, so University of Phoenix, they have to answer to FASB just like Target or Walmart, Apple. They're just a company, all right? So, and we're not going to talk about them. So GASB is for the governments, FASB is for private. There is this other entity called NACUBO, the National Association of College and University Business Officers. So like the CFO of the universities, they get together and they discuss, how are you going to work this? This is kind of weird. Hey, our summer school starts June 4th, right? Our summer school starts June 4th, but you know what? Our college year, fiscal year end ends June 30th. How do you divide that up between, right? So summer school is going to run past our year end. How do we do? What do we do with our tuition, right? So NACUBO, they make these little fine point distinctions, you know. So GASB says for a college or university, which is like an entity, so it's a business activity. It's going to fall under business activities. So what are we using for business activities? Think back to that chapter where we talked about the water department. They use accrual-based accounting. So at the end of the fiscal year, you accrue that stuff, and then you lump the rest in the next fiscal year, right? So so there's rules, but they tell you exactly how we propose you apply the rules. But they don't actually make the rules. All right, so most public colleges, so remember, public colleges belong to the state. They're governmental, right? They report as special purpose governments engaged in a business type activity, right? Like so they're reporting out on their own. They may appear discreetly on the state government, and you can go to find the state of Texas, and you'll see they have a column for universities. You won't see one for Texas A&M Kingsville, Texas A&M Corpus. I mean, you will back in the notes, but in the actual government-wide statements, those two statements, you won't see a separate for every university. You just see one big column for all universities. It's not even by system, just all universities. Financial reports follow the enterprise funds, so it's a lot like doing an enterprise funds because it's a lot like running a business. Charge for services, but get some appropriations and grants, have capital projects, all that kind of stuff. So it's a lot like doing enterprise funds. And they certainly do use the accrual basis. Private colleges, like other not-for-profits that are non-governmental, use FASB rules, which of course again is the accrual basis. Financial reports are a lot like those that we talked about in Chapter 10. So this is just sort of adding a little bit of specific information to Chapter 10. It's like they're not something different. They're still a not-for-profit organization that's non-governmental. Just, you know, universities have some unique special things going on, what with scholarships and tuitions and some grants, and they get Pell Grants from the government, stuff like that. So there's some slightly different things we like to keep track of. Right? So here's a little summary of what financial reports you have to report out for the different ones. Now, I'm not going to ask you any question about investor-owned ones like University of Phoenix, so don't even worry about that. But if you don't already know what the four GAAP compliant financial statements are for a company under FASB, you probably shouldn't be in a senior level accounting class, right? You have to have balance sheet or statement of financial position, income statement, owner's equity statement, and cash flows for those. But don't worry about that. So we have public, which is us, and it's like governmental stuff that we've already learned. You have the management discussion and analysis, statement of net position, statement of revenues, expenses, and changes in net position, cash flows. Because remember, we're doing this like the proprietary funds, like an actual business enterprise would. So statement of cash flow, you got notes, and your required supplementary information. You know, your statistics. So like how many students, stuff like that, over 10 years. The private not-for-profits. So like Rice University, Harvard University, they have a statement of financial position or a balance sheet. They have a statement of activities, a statement of cash flow, and notes. So they're not required to have MD&A, management discussion analysis. They're not required to have that MD&A, but a lot of them do. I mean, so FASB doesn't say, oh, you're not required to have MD&A, but you can't put it in. You can stuff that it's like. They require stuff, but you're always allowed to go further, disclose more. And a lot of places do include that. So when it comes to that equity section, right, so if you're looking at the balance sheet or the statement of net position, right, what do we call that equity section? Assets minus liabilities equals what? Well, for a public college, you know it's 3 parts, right? There's it's a net position divided into 3 parts. We already learned this. Net position and capital assets, restricted net position and unrestricted net position. And just like chapter 10, you've got what's called net assets, right? Assets minus liabilities equal net assets. So unrestricted net assets temporary, restricted net assets, and permanently restricted net assets. And of course, for University of Phoenix, which is just a company, you have paid-in capital and you have retained earnings. So NACUBO gives some additional information. They're not the ultimate final word, right? But it is an industry group, and they make helpful recommendations. So if you ever became the CFO at a university, you might join this group, so that could help you make sure you're keeping up with the proper GASB or FASB as applies to you. So NACUBO does not supersede GASB or FASB. It's just providing guidance, like here's how you would do that, right? So FASB or GASB would have a rule, and this would tell you here's how you would implement that rule. So depending on what's going on at your school, they can help you decide how to book that transaction. So one of the weird things that goes on is revenues. So we've got 2 types of organizations going on here, and they get revenues from different sources, right? They get tuition coming in, they get grants coming in, or contributions, donations, government appropriations. If you're public, right? If you're Texas A&M Kingsville, you're going to get some appropriations. So how do you look at those in terms of revenues? Also, people get scholarships, right? So how do you look at tuition revenues, right? So one of the advices is that scholarships that don't require service to the college, in other words, you're not going to work, it's not a student worker, all right? They are actually, so if you give a scholarship to somebody, just like here's a scholarship, but you don't have to work, this is a scholarship here, or student athletes are not considered working, right? Because we don't pay people to play football. Technically, it's not a job, but we would pay somebody to work in the front office if we didn't have a student. So that's like a job, right? So what students were not paying, you don't have to show up at the library and shelf books. Here's $2,000 worth of tuition assistance, free. You don't have to do anything. And that's the same way it's looked at for athletes, although I'm sure they're working very hard, but that's not part of our business, I guess you'd say. So what happens is, if you don't have to do service in exchange for that tuition, then we need to reduce the revenue because we're not actually getting that tuition. So typically they'll set up a contra account and take those scholarships out of tuition. But if fees are waived, so you get some tuition assistance and you're going to work for it like as a grad student, and you not only, some of our grad students get paid and they get tuition waivers, all right? So that's an expense, right? Because they're working, so it's kind of like we're thinking about it like a salary expense. It kind of makes sense. If you're not doing any work, it can't be an expense, so it's a reduction in our revenue. But if you're doing work, it's an expense because otherwise we'd have to pay you salary expense. All right. So if the tuition or fee reduction is an employee benefit, the reduction is treated as an expense. Academic scholarships that do not require service are reductions in revenue, and uncollectible tuition and fees are reductions in revenue. what happens when more than academic terms cross more than 1 year? Now, most universities are going on different fiscal years. So here at the state of Texas, our fiscal year starts September 1st. All right. So this is saying June. Can only use June 30. We don't, but we use August 31st, which still has the same effect because fall semester starts before September 1st. So part of our fall semester is falling in the previous fiscal year. All right, so this is what we're talking about here. But here they're giving the example of summer school. All right, so frequently it's covering 2 fiscal years. So here's what you do. It's an accrual. So if it's falling across 2 different years, you just apportion that and you give those revenues and expenses equally. So if it's just 1 week out of the whole semester, like for us, it's typically 1 week in August that we're going to have to include in the previous fiscal year, and then the rest of it goes in the next fiscal year. But you accrue stuff and you report it out like that. Accrue any expenses for that year. So here's the functional categories for expenses that is recommended. Educational and general, with subcategories for instruction, research, public service, academic support, student services, institutional support, and fellowships. Auxiliary enterprises. So remember, a university is almost like a little city. It's got its own police force. You know, there are universities with hospitals. They certainly provide housing. They certainly provide food. So it's almost like running a city, for some, especially for a really big one like a UT in Austin, with a hospital, a big police force, lots of housing, lots of meals, providing their own water. So, you know, we here at Kingsville, some of our buildings are attached to wells. So anyway, the point being is, you may have auxiliary enterprises like a bookstore, hospitals, independent operations. So you might have some separate research development center. All right, so you're going to have separate categories where you're keeping track of your expenses. Also, you're going to categorize your revenues. All right, so operating revenues, tuition and fees, right? So running the place, right? Operations. Tuition and fees, grants, federal and state, auxiliary enterprises, so the bookstore, things like that, the hospital. Non-operating revenues. Investment income, right? Universities get a lot of cash in, they'll invest it in stocks, bonds, real estate, all kinds of things. Get some money off of that. Investment income, gifts, state appropriate. So if you're a public school like Texas A&M Kingsville, that part of your budget that's appropriated by the state legislature passes it and the governor signs it. Here's Kingsville, you're getting $10 million. That's not operating revenues, because we didn't really do anything to get it, right? Tuition, we did something. Pell Grant, that's non-operating for us. For a private, like for Rice, that would be a grant, so it'd be operating. Time restricted contributions for a private would be non-operating, and net assets released from restrictions on a private. So kind of working like private and governmental, so no really different there. The big differences are for public institution, Pell Grants are non-exchange revenues upon receipt of the funds. And for privates, they're like resources held in an agency relationship. In other words, the federal government gives the Pell Grant to Rice University, and Rice University is just passing that on to the student. All right, so I think we'll stop right there and take a little break, and we'll come back and talk about some more differences between public and private.